What's going on, everyone? And I'm thrilled to have you here today. Whether you're just starting out on your financial journey or looking to refine your strategies, you're in the right place. Today, we're diving deep into the world of investing, and more importantly, how to avoid some of the biggest mistakes that trip up new investors. Investing can be a powerful tool for building wealth, but it's crucial to approach it with the right knowledge and mindset. We'll explore the ins and outs of the stock market, real estate, and other investment opportunities. But first, let's talk about why so many people fail when they first start investing. It's not just about picking the right stocks or properties. It's about understanding the principles that guide successful investing. Trust me, I've seen it all. And by learning from these common pitfalls, you'll be setting yourself up for financial success from the get-go. Mistakes are part of the learning process, but some can be avoided with the right guidance. We're going to cover 5 major mistakes, break them down and give you actionable steps to avoid them. These mistakes range from emotional decision-making to lack of diversification and not having a clear plan. Each of these can significantly impact your financial growth if not addressed properly. Before we jump in, make sure you hit that like button, subscribe to the channel, and turn on notifications so you don't miss out on any future videos about building wealth. Your support helps us create more content to guide you on your journey to financial freedom. So let's get started and make those millionaire dreams a reality. This is like setting off on a road trip with no destination in mind. Imagine packing your bags, filling up the gas tank, and hitting the open road without any idea of where you're headed. You might enjoy the journey for a while, but eventually you'll find yourself lost, frustrated, and unsure of where to go next. You might end up somewhere, but it probably won't be where you wanted to go. Without a clear plan, you could find yourself in a place that doesn't align with your goals or expectations. It's like arriving at a random destination and realizing it's not where you wanted to be. Before you even think about buying a single stock, you need a solid investment plan. This plan acts as your roadmap, guiding you through the complex world of investing. It helps you make informed decisions and stay on track, even when the market gets turbulent. Start by defining your financial goals. What do you want to achieve with your investments? Are you looking to build wealth over the long term, or do you have specific short-term objectives in mind? Clearly outlining your goals will give you a sense of direction and purpose. Are you saving for retirement? This is one of the most common investment goals, and it requires careful planning and a long-term perspective. Think about the lifestyle you want to maintain in your golden years and how much money you'll need to support it. A down payment on a house? Home ownership is a significant milestone, and saving for a down payment can be a major financial goal. Consider the timeline for purchasing your home and how much you need to save each month to reach your target. Knowing your goals will shape your investment strategy. Your objectives will influence the types of assets you invest in, the level of risk you're willing to take, and the time horizon for your investments. A clear plan ensures that every decision you make aligns with your overall goals. Next, determine your risk tolerance. This is a crucial step in the planning process. Your risk tolerance is your ability and willingness to endure market volatility and potential losses. It's influenced by factors such as your financial situation, an investment experience, and emotional comfort with risk. Are you comfortable with aggressive investments, or do you prefer a more conservative approach? Aggressive investments like stocks have the potential for higher returns but come with a greater risk. Conservative investments like bonds offer more stability but typically lower returns. This is crucial because your risk tolerance will dictate the types of investments you'll be comfortable holding. If you take on more risk than you're comfortable with, you may panic during market downturns and make poor decisions. Conversely, being too conservative might prevent you from achieving your financial goals. Lastly, consider your time horizon. This is the length of time you expect to hold an investment before needing the money. Your time horizon can significantly impact your investment strategy and risk tolerance. When do you need the money? If you're investing for a long-term goal, like retirement, you can afford to take on more risk because you have time to ride out market fluctuations. However, if you need the money in the short term, you'll want to be more conservative to protect your capital. Investing for retirement allows you to take on more risk, while investing for a short-term goal like a wedding requires a more conservative approach. By understanding your time horizon, you can choose investments that align with your financial goals and risk tolerance, ensuring that you stay on track to achieve your objectives. Remember the GameStop craze? Yeah, that's a prime example of why following the crowd can be disastrous. Just because everyone's jumping on the bandwagon doesn't mean it's a good investment. Independent research is key. Don't blindly trust what you see on social media or hear from your friends. Dig into a company's financials, understand their business model, and make your own informed decisions. Remember, what's right for someone else might not be right for you. Develop your own investment philosophy and stick to it. Don't let the noise of the crowd drown out your own judgment. Mistake number 3, putting all your eggs in one basket. Why diversification is key. Imagine putting all your money into a single stock only to have that company's value plummet. This scenario is more common than you might think. Companies can face unexpected challenges, market conditions can change rapidly, and even the most promising stocks can take a nosedive without warning. That's a recipe for disaster. When you concentrate all your investments in one place, you expose yourself to significant risk. If that single investment fails, you could lose a substantial portion of your wealth, leaving you in a precarious financial situation. Diversification is about spreading your investments across different asset classes like stocks, bonds, and real estate. By doing so, you reduce the impact of any one investment's poor performance on your overall portfolio. This strategy helps to balance risk and reward, providing a more stable financial foundation. It's also about diversifying within those asset classes. For instance, within the stock market, you can invest in a variety of industries and sectors. This way, if one sector underperforms, the others can help offset the losses. Don't just invest in tech stocks, for example. While the technology sector can offer high returns, it can also be highly volatile. By spreading your investments across different sectors, you can mitigate the risks associated with any single industry. Spread your investments across different sectors to reduce your overall risk. Consider sectors like healthcare, consumer goods, and energy, each of which can perform differently under various economic conditions. This approach ensures that your portfolio is not overly dependent on the success of one particular sector. Think of it like this: diversification is your safety net. Just as a safety net protects a trapeze artist from a fall, diversification protects your investments from market volatility. It provides a cushion that can absorb shocks and help you maintain financial stability. If one investment performs poorly, the others can cushion the blow. This balance is crucial for long-term financial health. By having a mix of investments, you can achieve more consistent returns and reduce the likelihood of significant losses. Remember, a well-diversified portfolio is designed to weather market storms. It can help you navigate through economic downturns and come out stronger on the other side. Diversification is not just a strategy, it's a fundamental principle of sound investing. By spreading your investments wisely, you can build a resilient portfolio that stands the test of time. Mistake number 4, letting your emotions call the shots. Investing can be an emotional roller coaster. One minute the market's up and the next it's down. Letting your emotions dictate your investment decisions is a surefire way to lose money. Fear and greed are your worst enemies in investing. Don't panic sell when the market dips, and don't make impulsive decisions based on hype. Stick to your investment plan and make rational decisions based on your long-term goals. Remember, investing is a marathon, not a sprint. Stay disciplined, stay patient, and don't let your emotions get the best of you. Mistake number 5, treating investing like a one-time thing. The world of finance is constantly evolving, and what worked yesterday might not work tomorrow. That's why continuous learning is essential for any investor. Stay up to date on market trends, read books, listen to podcasts, and never stop expanding your financial knowledge. The more you learn, the better equipped you'll be to make informed investment decisions. Remember, knowledge is power, especially when it comes to your money. Treat investing like an ongoing education, and you'll be well on your way to financial success. So, there you have it, the 5 biggest investing mistakes to avoid. By steering clear of these pitfalls and implementing the strategies we discussed, you'll be well on your way to achieving your financial goals. Remember, investing is a journey, not a destination. It's about taking control of your financial future and building wealth over time. If you found this video helpful, don't forget to give it a thumbs up, subscribe to the channel for more investing tips, and share it with anyone who might benefit. Thanks for watching, and I'll see you in the next one.